Hey, it's Ted McGrath. Welcome to tonight's show. So I'm going to jump in. We're going to talk a little bit about the Trump tariff cuts, the Fed rate cuts, and why Bitcoin and Ethereum and MSTR and BMNR are still struggling, chopping, going down. What is the cause of this? I'm also going to get into whether Bitcoin is losing steam in this bull run. I'm going to show you a chart where I actually believe this is not the end of the run for Bitcoin, and I'm going to show you why. And we're going to get into a little bit about strategy and their Q3 earnings report. And I'm going to show you a clip from Michael Saylor today, which is a very, very powerful video that Michael Saylor put together. So not tax advice, not financial advice, not legal advice. Do your own research. And ultimately, if you want to dive more into what's going on in the markets, down below, I have a book called Money Game. It can help you understand Bitcoin, Ethereum, MSTR, and BMNR better. I also have a video that comes with it that shows you my trading strategy. So while the market was dropping today, yesterday, and doesn't look good, I picked up about $7,000 that I reinvested back into shares of BMNR today. So when the market's going down, I'm still picking up gains and adding and stacking to my portfolio. So how am I doing it? It's down below. You can grab it for free, and I hope it serves you, because when the markets go down, it is no fun and nobody likes it. And nobody likes the bearish news right now, what's going on. So we're going to get into it and talk a little bit about the geopolitical and market news today. U.S. President Donald Trump and China's President Yi reportedly reached a basic trade framework in South Korea. Not that it mattered much for Bitcoin, but China said it will restart selling rare earth materials and buy U.S. soybeans again. U.S. lowered some tariffs, cutting from 57% to 47%. Basically, both sides hit the pause button on their trade war, which is good news for the economy. Easing tariffs should boost risk assets like crypto and stocks, but it has not done that yet. And so I know it's very disappointing for everybody, but the market's reaction says otherwise. Bitcoin and Ethereum dropped right after the news, as you saw. So this is a little market recap for the week. We saw Bitcoin go actually in as low as 106,000 and change if you were watching the markets. Ethereum dropped down to about 3,600. So this is showing 3,700, but it actually dropped down to 3,600. And the sell-off wasn't just about geopolitics. We had a rate cut where Powell confirms a rate cut, but warned about inflation, tariffs, and a slowing economy. This is a nice post here that says the Fed just cut rates 25 basis points. They made this decision without September jobs data because of the government shutdown. So flying blind, but still cutting. But again, as you watched my video the other day, Powell says that December rate cuts are not a foregone conclusion. The market doesn't like uncertainty, and Bitcoin dumps, Ethereum dumps, and it's very fascinating to see what's going on right now. But there's some news to show you where I don't think that this run is over. I don't think Bitcoin's done. I don't think MSTR is done. I'm going to show you some charts why in just a few minutes here. So we saw like 307 million in long liquidations as a result of that news. 41 million in outflows from Binance and Coinbase. Whales were taking profits during the volatility, and ETF outflows hit 470 million. But funny enough, during October, the inflows are still positive. We still had lots of inflows coming into Bitcoin. So heading into November, we know that October was, you can call it Craptober, because it was no good. Bitcoin was down about 4%. Heading into November, the setup looks cleaner. Exchange balances are at a 12-month lows. Holders aren't selling. The Trump-Yi deal eases global risk sentiment, and the Fed rates, they get cut. They still favor long-term risk assets. So we're going to take a look at this volatility that's happening. The fundamentals could still be bullish, and I'm going to show you with the chart here why in just a moment. Now, when you look at strategy, it slipped roughly 18% in October. It's probably climbed a little bit higher today, back up to 279. So that's not exactly 18%. It's probably more like 16, 15%, but still not pleasant to look at. And we're now deep into the final stretch of the question mark here. Are we still in the bull run? I think it's consensus that we're going to have a longer cycle here. It's possible we still have a run up in November and December, but I think the consensus is this might go into 2026. And that's what I think could happen. The question on everyone's mind right now, are we close to the peak? Have we burnt out? Have we lost steam? And when you look across every major chart, Bitcoin, gold, and even the S&P 500, we're seeing the same pattern. There's a setup that typically comes with gold and this equities before the bull run. So the question is, will it happen? Now let's look at history here. If you look in 2022, Bitcoin was at 15,000, and at its peak this year, it hit $126,000. So since 2022, it's up 7x. Now it's cooling slightly near about $109,000 today. You look at the S&P 500, 18% this year, all-time high. Tom Lee called it. He said back in April that the S&P would break 6,600 when the S&P was low and Bitcoin was low, down to $70,000, and he called it, and it has broken that. Tom's still holding on to his predictions that this is going to be a good fourth quarter, but we know 1 month of the fourth quarter has not been good yet, so let's not sugarcoat it, okay? So sitting at an all-time high with the S&P 500, bullish for the S&P 500. Gold went up 66% in 2025. It hit an all-time high. And then we had a 10% pullback to around $3,950. And every major asset class has rallied hard. And historically, this kind of alignment signals that liquidity is flooding into the system. We heard the Fed talk about quantitative tightening will end on December 1st. So that's good for more liquidity in the economy. And if you take a look at this chart, this is just a history. When gold hit its top in 2020, then you had Bitcoin run up in 2020. Gold hits its top in 2025. Bitcoin could potentially follow, but we just have a delay on Bitcoin. It looks that way. When gold peaked around 2,100, Bitcoin exploded straight after, and that was in 2020. Fast forward to 2025, gold just topped nearly $4,300, pulled back 10%. And if history repeats or just rhymes, then that same capital rotation could once again ignite Bitcoin's next leg higher. And that's what we're all hoping for and wanting. So the big question is, when's the top? And I'm going to fast forward through this and just show you some other stuff here and get to the chart, because I think this is an interesting chart for everybody to take a look at. So you have the halving cycle, 2012, 2016, 2020, 2024. This is not the main chart I want to show you. There's another one. 2012, 2016, 2020, each having kicked off a bull market. Bitcoin exploded 8,000% in 2012. 2016, 2,800%. 2020, 559%. Historically, it was simple. You had the halving, you had the supply shock, you had the price surge, and everybody was like, wow, it's going through the roof. It's different this time. But if you follow the stat pattern moving forward, we should have had a peak already in October 2025 back on based on the history of how bull runs have gone. And we have not had that yet. Okay. So this cycle isn't like other cycles. It's different. And I think there's lots of consensus that we're in a different cycle. And of course we are. It's obvious because we have not hit the peak of Bitcoin yet. That's my point of view. Some people think it's over. We're out of the bull run. We're going to go lower. We very well may go lower. I still think we're going to have some momentum in 2025 at the end in the last 2 months here. And I still believe this will go into 2026. The supply story hasn't changed forever. So if you look as of today, 95% of all Bitcoin has already been mined. So the digital gold rush in 21 days, 95% of all Bitcoin will have been mined. Of the remaining 5% Bitcoin, 4% will be mined in 2035. From then on until 2140, everyone will be fighting for the last remaining 1%. This is strategy, and that's not investment advice. They say take action now, buy Bitcoin. That's not advice from me. That's just them saying in the slide. So pretty interesting to see what's happening with the supply. That final 1% is going to take over 100 years. So each halving now has less impact. The supply shock gets smaller, and price cycles naturally start stretching longer, okay? So now we're going to take a look here at the charts for Bitcoin. And this is an interesting chart. I've shown this. It's probably my third or fourth time showing this. So I'm going to show you here this chart right here. Okay, great. So if you look here, at this MVRV Z-score, you can kind of look at this as the temperature for Bitcoin, okay? And so if you look historically, follow the chart, and what you want to put your eyes on is the big yellow line spiking up, and when the yellow lines spike into the red zone. So if you look back in 2013 and 2014, we spiked into the red zone. And so the yellow line in 2013 and 2014 spiked up into this reddish or pink zone, you could call it, right? And so that means when Bitcoin started hitting 7, if you look over to the right on the graph, it goes 0, 2, 4, 6, and right at that red line, it's about a 7. So when the yellow line crosses over into the pink reddish zone, which happened in the 2013-2014 bull run, when that happened, that meant Bitcoin was overheated, it was overvalued, and the sell-off came shortly after. If you look at the same thing in 2017 or 2018, I remember I was in Park City, Utah when this happened, and I remember there was a blow-off top with this. Bitcoin went up to about $20,000. So you see this yellow line spikes above above 7, and when you get into the number 7, that's in this pinkish zone, and that means it's overheated, it's overvalued, and there's going to be a sell-off typically. And then you look in 2021, you look at the same thing where it just hit the line, the pink zone, and it just hit the 7 zone, which meant it was overvalued and overheated. And now go to 2024 and 2025, and we have not hit that. So if the overheated part of Bitcoin would be in the 7 area, right now we're at about a 2.3, 2.4. So this means that Bitcoin is not overheated. And we have not had a season yet in 2024 or 2025 where there's been an overheating, where Bitcoin's been overvalued, where it hit the euphoria zone and then it sold off. So we haven't seen that yet, which leads me to believe that we're probably going to extend into 2026 on this, but I don't think that Bitcoin is done. Now, not financial advice. You need to make your own choices, your own decisions. Certainly, you have whales in the marketplace that are taking profits right now. You have people that are taking profits. I am holding on to my Bitcoin, and I'm holding on to my strategy, and I'm holding on to my BMNR. All right. And I just believe that we're in an extended cycle, and things are going to heat up eventually. And I'm still holding on and putting my money where my mouth is. That doesn't mean that you have to do that. I'm just saying that's what I'm doing, and that's what I believe. So none of this is tax advice or financial advice. And also, I think one of the things that you look at when you're investing and you're learning about what's going on in the markets, I think the number one thing is to have knowledge and to have confidence. When you have knowledge and confidence, you have more control over your money. So it's great being on shows like this. It's great when you go listen to other YouTubers, when you do your research out there in the marketplace, because without the knowledge, one doesn't really have the confidence and certainty in what's going on. And so I'm going to show you a video from Michael Saylor, because when I watch these videos, I get so reinvigorated about the future of strategy. And for me personally, I'm already in major profits. I'm 3x profits on strategy from when I first bought. And so if you average out all my buys, it's close to 3x, 2.5, or somewhere around there. So I'm very high in profits. But when I watch Saylor and what he talks about, it's important to look at the long term as well. So I'm getting prepared. What if we don't hit a bull run? What if Bitcoin doesn't go all the way up? What if strategy and Bitcoin chop and then go down? I'm then holding into, the future with these assets. And that's my current plan right now. And I just like what Saylor's saying about strategy. I like what he talks about in terms of Bitcoin. He talks about time horizons in their Q3 earnings report. So if you don't have a good understanding of strategy, this video will help you. If you don't have a good understanding of Bitcoin, strategy, BMNR, Ethereum, you can get my book down below. I think my book will really help you. It goes into these things in depth, in length, and it's an easy read, and it's backed by data. And then also, if you want to understand how to really, own the market even when it's down, you can learn my trading strategy down below, because I'm picking up shares every single week. This is my 15th out of 16th week being profitable with BMNR, trading it. And when I say profitable, every time BMNR drops, I'm trading it. So for example, today, let's assume there was a drop today on BMNR. I picked up roughly 3.5%. So if the stock went down, which it did at one point today, I picked up about $7,000 in shares by trading it. And so every time I do that, I'm lowering my cost basis. So when I bought into BMNR, my cost basis was around $60. I bought in 3 months ago, maybe longer, 3.5 months ago. And so over the last 3.5 months, I've just traded down, traded. And I've lowered my cost basis heavily, picking up more and more shares. And even now, if you do the math, if you know how to trade and you know how to pick up shares, if you do the math on it, if you were to make a $7,000 profit today, like I made a $7,000 profit approximately, okay? Might have been 6,900 and change or 7,100, somewhere around there, okay? So when you look at the picking up BMNR shares, let's say at $46, if I have $7,000 gain and I'm buying 7,000 more shares of BMNR at $46, then I'm picking up a lot more shares with $7,000 at $46 per share, versus if I had that same $7,000 and I was investing at $60 per share. So the bottom line is my $7,000 gain today buys a hell of a lot more shares at $46 on the BMNR stock price. So the opportunity when the market drops to pick up more shares, for me, it's something that I believe in. It's something that I'm holding. I'm waiting for it to go up. But even as it's struggling and chopping, I'm able to win by picking up more shares, which lowers my average price, which in the long run, when BMNR goes back up, I have so many shares I'm picking up at a lower price point. When BMNR was down at $40, I was trading the hell out of it in August and September. $40, $42, $43, I was picking up tons of shares trading it. So I just think today in the markets, like, one really needs to have a good understanding, if you're just holding as a long-term investor, not financial advice, but just a good understanding of what it is you do hold, number one. Number two, not just holding the asset. I think anyone can learn how to trade today. And even at the beginning of the market today, I have a simple strategy I use, and I picked up $1,500 in literally, and this is not an exaggeration, I placed the market opens at 6:30 for me PST. At 6:28, I sold out some of my shares. At 6:31, I made $1,500 in about 90 seconds. Okay. So there's things you can do to be cause over your finances by getting the knowledge and education. I think it's one of the most important skills on the planet right now that somebody can learn, particularly with the fact that if you're looking at the current state of the economy, even though the S&P 500 did 18% so far this year, it has to do 18% for traditional finance to win, because you just got to make 12% to keep your head above water. After taxes, inflation, management fees, if you're paying financial advisors management fees, after all of that, and you take into account asset inflation, 12% doesn't get you anywhere. It's like you're going 250 miles per hour in a plane, and then you have a headwind coming at you at 250 miles per hour. It doesn't work. You're going nowhere. So understanding the game of finance is so important today, considering the fact that the economy isn't just built for middle-class America to win. It's just not. And Saylor's going to talk in this video, and I want you to pay attention to what he's saying in this video. Yeah, MSTR earnings were really good, but listen to what he's saying in this video, because if you get the vision of what strategy he's doing in the future, and I really believe in the ethics of Saylor and what he's doing. Like, he's doing the right thing for the shareholders, and you'll hear what he's saying, and you'll hear his vision for the future. And when you compare that to the banks, he's talking about Bitcoin, and he's talking about when he's issuing stuff like, you've heard of the preferred stock that he issues, like you have Stride, you have Strike, you have Stretch, you have Strife. So these 4 different vehicles, he calls them credit instruments. And really what a credit instrument is, because you're going to hear him say it, but he's not going to explain it. A credit instrument is a promise to pay. So when he talks about credit instruments, people are like, what the hell is he talking about, right? Like, in English, it's a promise to pay. So when somebody puts their money in Stretch, and you've heard a lot about Stretch recently because they're comparing it to money market accounts. And Saylor even talks about it in this video where he says, like, we're paying out 10%. And they figured out a way when they are paying out this 10% to where the dividend that's actually paid out to the customer who owns Stretch is a it is a deferred from a tax perspective. So when the customer is getting that 10% off Stretch, they're not actually paying taxes on it right now. So Saylor remarks in this video, and he says that, that's more like a 15% rate of return because there's not a tax being paid on that 10%. So when you look at what strategies do in the marketplace, when you look at traditional instruments that are out there where a company might say, hey, give me your money and I'll promise to pay you back 5% or 6%. Strategy saying, give me your money and I'll promise to pay you back 10%. So when he calls them credit instruments, all it means is it's a promise to pay back. The difference is that Strategy's promise to pay back is based on their vault that has Bitcoin in it. So the promise to pay is like, we promise to pay you, but take a look at our vault. And if you looked at their earnings yesterday, they almost had $4 billion in earnings. And so when you look at their vault backed by $74 billion in Bitcoin, and they're saying, we promise to pay you this 10%, and we're good for it because we have $74 billion of Bitcoin and about $9 billion of debt. Versus when you go to a typical institution, let's say you even go to a bank, and a bank's going to pay you 5%, right? So a bank is a very different type of credit instrument because a bank's promise to pay is not backed by Bitcoin. And so there's a very interesting thing that happens. And if you get this, like this is what fascinates me about money. It's why I wrote my book, Money Game. You can get it for free. Give it to your friend down below. I've been giving it out to all my friends. They love it. And I wrote this book because I wanted people to understand how money works. Because if you really understand how a bank works and how Strategy is so much different, and I'm not saying that they're a bank, but how Strategy, when they issue a preferred stock like Stretch, and they say we're going to pay you 10%, they're good for it because they're backed by $74 billion of Bitcoin. And we know Bitcoin is a hard asset, and we know that Bitcoin is a real asset that has scarcity and it's finite. And we know, and the worlds have agreed on this. Like financial institutions have agreed on this. We have governments that have agreed on this. There's 12 different, nations and governments that are mining Bitcoin right now. The world has agreed that Bitcoin is a hard asset, okay? But when you look at how the banks work, when you go into the bank and you put your deposit in the bank, what you're actually doing when you put your $1,000 or $10,000 in the bank, you're actually loaning the bank money. It's actually a loan. And so you loan the bank money, they're borrowing from you. And the moment that you give them the money, they then owe you that money. So it's a promise to pay. The difference with their promise to pay is their promise to pay isn't backed by anything. It's backed by numbers on a screen. Because when you loan the bank money, and this is what happens when you put your money in the bank, you're loaning them money. Okay? They're borrowers. They take your money, which they give you 1% for your money, if that, and then they'll loan it out for a car loan or a mortgage. And so they take your 1% and they turn it into 5%, 6%, 7%. And they keep doing this over and over again, hence the velocity of money. So when you look at traditional finance and how it operates, where the backing of the promise to pay is backed by the decree of the financial institution. Because when you look at fiat currency, what fiat actually means is decree or statement. So the dollars that are floating around today are based on decree, statement of your government. It's worth something because the government says it's worth something. It's worth the fact that I say I have an IOU to you. I will pay it back to you. I promise to pay it back to you. It's based on their statement, their good word. And then the dollar itself in the global economy is worth the word of the government that's in $38 trillion in debt. So when you start to look at really what's happening here in the actual economy of how the dollars work in the U.S. economy, it is a very, very interesting system when you start to look at it. And the way that the Fed works and the way that the Fed prints money is a whole nother rabbit hole that you can go down and understand how it operates, because it's not a very sound system. And so now when you look at Strategy and what they're doing and how they actually operate, I want you to hear from Saylor right now because it's extremely powerful. And, Strategy is one of the reasons why I wrote my book, Money Game, because I wanted people to understand Strategy. I wanted people to understand Bitcoin. It's like, how could I invest in Strategy if I don't understand Bitcoin? How can I really invest in Bitcoin if I don't understand the state of the current economy with traditional finance? And traditional finance, in my opinion, is not very good. And so we're going to hear from Saylor on this here, which let me know that you can hear him when I'm playing this video here, because I want to make sure that you can actually hear.
With equity, I would say if you're going to own Bitcoin, you need a 4-year or longer time horizon. If you're going to own amplified Bitcoin, a company that aims to be more volatile than Bitcoin, you can't have a lower time horizon. So you probably need a longer time horizon. So we manage the company such that we think 10 years from now, we're going to create an insane amount of shareholder value. And that doesn't mean we're looking for 10-year payoffs. We're generally thinking if it doesn't return what we expected within 4 years, we'd be very disappointed. But we never do anything where we demand to get the payback in 4 months. And so we don't have a 4-month time horizon or even a year time horizon. And we think that generally, I would say if your time horizon is 12 weeks, you should own the STRC, right? You really should go to the short end of the risk curve and the short end of the duration curve, because that one we're trying to strip volatility away. And if your time horizon is 10 years, and if you are Bitcoin maxi, then maybe you like the equity or you like Bitcoin. The credit instruments, I would say, if we wanted to raise the max amount of capital, then we could do two things that we don't do. One thing we could do is we could just open up the ATM and we could sell stock at any MNAV any week all the time. And what you've seen is we don't do that. After the red sweep, when there was a massive enthusiasm, we would sell $1 billion or $2 or $3 billion of stock, like a billion in a week or 2 billion in a week. And so you see, we're not shy when the market is strong and the premiums are high. We would go very hard, but you see a lot of weeks where we sell nothing. And we could have sold $1 billion of equity a week. We chose not to sell any equity. If the equity is weak and it's crashing, it's almost certain. In fact, it is certain we're not the ones doing it, right? We're watching, right? Because our view is we only sell into strength, and we only sell into strength when we like the premium. So we have actively decided we don't want to maximize capital by selling equity. And then I think the other thing is, just like we could raise $1 billion of equity in a few days if we wanted to, I could also pick up the phone and I could raise $1 billion overnight in debt. If I just said we wanted to do a pipe deal with a debt investor, I would have 12 firms over the weekend. And by Monday morning, we could have raised $2, $3, $4, $5, $6 billion. They would be licking their chops and delighted to give us the capital. They would want to be senior to all the other creditors in the capital structure. And what they would do is they would undermine the creditworthiness.
So PIPE is private investment in public equity, just so nobody has misunderstood words on it. Private investment in public equity. So he's saying he could go out and get a fat amount of money right now if he wanted to take on that kind of money. And he's saying he doesn't want to take on that kind of money.
Of the preferred instruments that we actually want to sell. So you could just assume with our 75 billion of capital right now, we've already chosen not to raise 20 billion or 30 billion. We could be $100 billion, but we'd be 100 billion, and the risk profile, the leverage wouldn't be 11%. The leverage, would go up, and so we actively decided that we don't want to generate leverage, right? We're literally on a path to drive leverage down. We're also on a path, we've decided we don't want to do deals that don't have positive BTC yield. But more importantly, we're on a mission. The mission is to create the digital credit market. So I think the company has two speeds. Well, maybe more than two speeds. When we're coasting, when the credit markets don't offer us anything compelling and the equity markets aren't compelling.
So just to be clear on the digital credit market, he's talking about when he's issuing preferred stock like Stretch, which is comparable to a money market fund. If you saw the video I did the other day, He's talking about, stretch in there, or I was talking about stretch in there. And so it pays 10%. And the metaphor people use is it's a money market fund, even though it's not. And so it pays about 10%. And so what he's saying with a credit instrument is like, you give us your money. Let's say you give $100,000 into stretch. We will promise to pay you back 10%. That is a credit instrument, a promise to pay. So when he says that, it's like, give us your money, put it into stretch. We'll promise to pay you back that 10%, and we'll take your money to buy Bitcoin. So all these are credit instruments that he's explaining. Strife, Stride, Strike, they're all credit instruments, because when you give him the money for stretch, for Strike, or Strife, or Stride, or Stretch, it's a promise to pay you back. Make sense? And that's why it's called a credit instrument. Okay, so let's continue on with it. I'll just stop at certain points to just, clear up some things, because sometimes the language is a little bit above even my vocabulary.
We are coasting, and in my mind, I think that is a $75 billion company growing 30% a year for the next 20 years. So that is an idle. And then for those of you who know me, I believe in the Hippocratic Oath: do no harm. And so the risk-free rate, the company is going to get the 30% a year for 20 years if we take no risk. So how do we, what can we do where we feel like it's worthwhile? And of course, if we sell credit, we can take that 30% to 40% or to 50%. But we have an agenda here. The agenda is not to artfully manage the balance sheet. It's like if you told me, well, you could issue $10 billion of junk 5 to 7 years and roll them every year and roll them every quarter, and you could pursue a credit strategy based on debt that gets you a lot more capital, and you're continually rolling it. And you would do that with 144A offerings. We could fire up a $2 billion 144A offering next week, and we just go do it. But the point is, we don't want to be the revolutionary company that adopted digital capital that grew the company with conventional, traditional credit. We want to be the revolutionary company that discovered digital capital, that then went on to discover and found the digital credit market. And, when you're just rolling a bunch of 5 to 7 year bonds, and when you're opportunistic, then, you're careening toward the future with an advantage. I want MSTR to stand for monster. We want to create a monster company. We don't want to careen toward the future with an advantage. We don't want to be the talented fighter, that kind of wins and loses, and mostly wins and is a little bit sloppy and undisciplined. We want to create the digital credit instruments that are 2 to 4 times better than everything in the $300 trillion market. And we want to eat the world, right? And we want to sell $100 billion of them. And after we sell 10 billion, then 20 billion, then 40 billion, then 80 billion, when people go, well, aren't you levered? We want to say, well, actually our leverage is 0. Huh? What? Wait, what? We have 30% amplification, but we don't have 100 billion of debt. We have 100 billion of equity that happens to actually amplify the common equity. Let me educate you on a new way to build a company. So I would say you want to boil that down. It's a very disciplined growth strategy. We would rather coast and have a bulletproof balance sheet and a $75 billion company growing 30% a year than to stretch for capital or stretch for some kind of yield, but undermine the balance sheet and take on credit risk. Because someone says, I'll give you $10 billion tomorrow, and it's senior to STRC. We just created volatility, and we crumpled the credit of the instrument that is going to provide a comfortable retirement to 1 billion people. I don't want to be the dude that made a good trade that made 25 or made $50 billion by trading Bitcoin by using cheap corporate money. We don't want to be the company. that made 25 or 50 billion dollars, or a Hail Mary, or maybe we lost it by whatever, borrowing money, however we can get it to buy Bitcoin. We want to be the company that provided a comfortable retirement to 1 billion people and changed the world, right? We want to change the monetary system. I want everybody to get up in America and say, I'm not getting paid 10% tax deferred from my bank or from my money market. That's not fair. That's an abomination. I'm going to tell all my friends that I'm so mad about it. I'm going to go tell my 100 people that I know, they all need to pull their money out of the money market. They need to buy Stretch. And we want to be in a position where we can accommodate that demand.
So if you really look, and I'll continue to play what he's saying, but it's very important. He's saying that, Stretch is like, you're going to be the new money market per se. So rather than people going to put their money in a money market, put it into Stretch, get 10%. It's tax deferred. The fact that it's tax deferred, it's like a 15% return today. Because if I was to pay taxes on a 15% return in a 30% tax bracket, the net is 10. So you're growing in a tax deferred fashion, which is now 15% versus 10%. And he wants to provide this vehicle to billions of people and provide them a retirement, because he knows, and he's very clear on, if you're not earning 10%, if you're not earning 12%, you're treading water. You're literally, treading water. So he's giving people a 15% theoretical gain on this because the tax is being deferred. So it's really brilliant what he's doing. So when he talks about money markets versus Stretch, he's like saying that the Stretch is like the new money market, metaphorically. And it's going to be a much better choice for people all over the world than it is to actually put your money in a money market. So you look at I think the money market value is about $129 trillion in equities, and in real estate you got about 300 trillion. So Stretch can pick up a bunch of money in the bond market, a bunch of money in the real estate, in the money marketplace. There's trillions, hundreds of trillions of dollars in there. Stretch just picks up a small percentage. That's huge for strategy today and moving into the future. So again, this is not to paint over the dirty garage that the stock is down right now. This is to reinstill confidence in the fundamentals of this leader and what he's trying to do for people all across the world. He cares. He wants to create a retirement for billions of people with this product Stretch. And when people go and invest money into Stretch so that they can live a comfortable retirement, getting paid 10%, which is like 15% pre-tax, then he's helping people all around the world. They're giving him money, and he's taking that money to buy Bitcoin. So us, or me, who owns MSTR, not sure if you own it, but for me or MSTR shareholders, that's good, because then he goes to buy more Bitcoin. So when you look at the future of this company, it is endlessly beautiful into the long-term future. We know in the short-term future, it can be a nightmare. So I'm not sugarcoating it. I love this company. I think it's a phenomenal company. I admire the hell out of Michael Saylor, and just listen to what he's saying. And I like to invest in leadership that I believe in, which is why I chose this stock to begin with, and I still hold the stock. So let's hear a little bit more from him breaking it down, but it's just a very, very powerful speech that he's giving here.
For $300 trillion of investors and for billions of people. And you know what? When we sell $1 billion worth of digital credit, they're giving us the money forever, and we're taking no credit risk. But the quid pro quo is we're giving them 10% tax deferred, right? And so I would rather pay 10% tax deferred and get the money forever than pay 5% and get the money in the form of a junk bond and pay a taxable 5% coupon, even if you wanted to give it to me. And Ben, you can see the obvious reason why. The world's full of 50,000 companies.
So he's saying here, if you compare it to like a junk bond that you're going to pay 5% on, you're going to pay a tax on that. So if you're in a 30% tax bracket, 5%, after a 30% tax is 1.5%. And so, excuse me, the tax is 1.5%. So you take 5 minus 1.5 and you have a 3.5% return. If you just look at inflation on an annual basis of being 3% based on what the Fed reports, and you're putting your money in a junk bond or, a bond like that, or a money market that you find that gives 5%, after a tax on that, your net is 3.5%. Inflation per what Powell reports is 3%. So you made no money, right? So you have inflation and taxes and you made zero. And that's just not the whole story, because then you have to look at the thing that I always talk about on the show, which is asset inflation. It's so important to look at it because you have to look at people in America, people across the world want to buy houses. And so when you have houses going up during the COVID time over the last decade by more than 5% a year, if you look at historically, houses have gone up over decades about 5% a year. And so when you look in the COVID era, of houses were going through the roof because of all the money printing. And so you have to take into account asset inflation, that if I'm going to put money in a money market or a bond and I'm going to get 5%, and I'm like, I'm making nothing with regular inflation and taxes, you put in asset inflation, I want to go buy a new house, it just chewed up your money. So your 5% isn't 5%, it's more like negative 2% at that point. So this is where the game is played, where a vehicle like Stretch that's offered to the marketplace, like he's talking about, that has this 10% return and does not have a tax on it right now, is more equivalent to a 15% rate of return right now, because you're not paying a tax on it right now. It's being deferred. So it's a very, very powerful organization that Saylor has with MSTR. These instruments of Strife and Strike and Stride are extraordinary. It's a brilliant stack of what they have. And you can hear him talking, and I don't know him personally, but if you hear the way he's talking, I see this as a very ethical man who wants to help people. And what he's saying is he's not willing to sacrifice his company by taking on money that he could go pick up tomorrow. He could go get billions of dollars tomorrow and go do a deal with private investors, a pipe deal, private investors investing in public equity, and he could pick up the money and he could go stack more Bitcoin. But he's not willing to do that. He's doing the right thing for the shareholders. He's doing the right thing for people who want to retire with these new products that are more conservative, the people who want less risk, put their money in Strike and Strife and Stride. And he's doing a wonderful thing for mankind. So you just got to admire the hell out of what you're hearing right now from this guy.
Companies are in the world that will give you 10% gleefully, enthusiastically as a rock dividend, and then do everything in their power to actually issue more dividends. So for us, the credit is the product, right? The aspiration or the offering is a comfortable retirement to everybody who's a credit investor. That's the offering. If we can do it by selling equity, we will. But when the equity, when the equity is dilutive, we won't. And we won't do debt, because debt is a conventional credit idea. It's a 20th century idea. I think I laid out with my 7 differentiators for digital credit. We think that digital credit is an inversion of everybody's value system. Every other credit issuer in the world gets up and says, how do I cripple the credit and pay you the lowest coupon and maximize the advantages to my company? And we get up every day and say, how do we create the greatest credit instrument that pays the highest tax equivalent cash flows that's going to be best for the buyer, right? For the investor. So that's
such an important point. He's just making such an important point there. I mean, they're really providing an incredible service to people out there. And if you watch my video the other day, I talked about S&P Global that is now rating Strategy, and Strategy got a B-, and I compared Strategy to JetBlue because JetBlue got a B-. And if you look at Strategy and the amount of Bitcoin they have on their balance sheet and how wealthy they are with it, and you look at JetBlue, who's got billions of dollars worth of debt and was negative in cash flow, they both got a B-. And so it just shows that, one, it's great that Strategy is actually being rated right now. and they're looking at their credit instruments, and they're looking at their S&P Global basically says, what is your ability to pay back the debt, or your promise to pay back what you owe people? So with strike, strafe, stride, and stretch, when people give money, he then has a promise to pay them back. And so S&P Global rates like how likely are they to pay back? How likely are they to give the money that they promised to their customers? And they give them a B minus, but it's one, at least they're on the scoreboard recognized by a rating agency like that, which is huge news. So it's really big news. But the fact that they got a B minus just shows that this space of having Bitcoin on your balance sheet, or Solana on your balance sheet, or Ethereum on your balance sheet like BMNR is so new that traditional finance does not know how to rate it, and it's just a systemic problem, because traditional finance it's slower than this economy. If you take a look at traditional finance, banks settle in 2 days. It takes so long for things to settle. You want to send a wire overseas, it could take 3 to 5 business days to do it. So the current system is slow. I mean, I was on the phone with the IRS yesterday for 4 hours. They owe me a very large check, and they don't even send email. They're still using fax machines. So you would look at this entire system that is an antiquated old system. So it's going to take some time for it to change, but you have people who are running into the future and already in the future, and they're literally waving the flag and saying, this is the way, this is where freedom is. That's what strategy is saying. This is where freedom is. We are doing something in the world that there's not another financial institution on the face of the planet that's doing what they're doing. Not one financial institution on the face of the planet that has Bitcoin in their treasury that can offer up these instruments at 10% and can literally, as they grow bigger and bigger and bigger, and they get better and better ratings and better recognition, you're going to have, your father or your grandfather one day who could retire on this, who literally couldn't retire before because he's going to get a measly 5%. He wants to keep his money safe, could now put his money into something that's backed in the future. Their Bitcoin balance sheet is going to be 100 billion, 200 billion, 300 billion, a trillion. And when they're backed by $1 trillion of Bitcoin, and they're issuing these instruments to say, hey, I can give you 10%, which is like really 15% because it's tax deferred basis. What do you think is going to happen in the world? Do you think they're going to go to traditional finance, who's literally trying to skimp and pay you the least amount? Or are they going to go to a company that's backed by real money, is what I'm going to call it. I'm going to call it money right now, even though it's a commodity, right? It's real. It's real because it's finite and it's scarce. And, the rest of the world is going to catch up one day, and it's going to take a while. As I was just saying, you have institutions like, the institution that collects our tax dollars is still working on fax machines, guys. So we have a very, very slow, antiquated technology in the current financial system. And this is the highway to speed. This is the highway to the rocket ship. And this is it. And strategy is running into the future. And then you've got companies like BMNR that are also, you can't deny that the future is the blockchain. Because what's the other option? The current system that's extremely slow, and the current system maybe served its purpose for the last 100 years or so. I don't know what purpose it served, and I don't want to badmouth the current system, but I just don't agree with how money works. Since 1971, it hasn't worked. And so we're living in an economy that needs a new system. And so when you have a company that has this much Bitcoin on its balance sheet and could grow to $1 trillion company, and I hope that more and more companies get Bitcoin on their balance sheets. So you have lots of company, and this becomes the new civilization. So Saylor is literally putting it there, and I don't think most people understand what he's doing, but he's doing it. Yeah, he's like, hopefully. He's like, I know exactly what I'm doing. And he's a brilliant man. So there you have it. A little recap on a few things here. I'm just going to fast forward into here because I went through the MVRV score here of why I don't think that Bitcoin has hit its peak yet. And I think we're in an extended cycle at this point, but it hasn't hit its euphoria zone like the past cycles when I showed it on the chart. So if you look at this, from Saylor. This was a video I showed the other day. His prediction is Bitcoin 150,000 by the year end. He's acknowledging the fact that it's grinding up. He thinks in 4 to 8 years, Bitcoin will be $1 million, and then $20 million in 20 years. The way he gets to a $20 million Bitcoin in 20 years is an average growth rate of 30% per year for the next 20 years would be a $20 million Bitcoin. That's how he gets there. Okay. Which is not too far fetched to believe that Bitcoin could do 30% per year over the next 20 years. So that's his predictions. We'll see if it comes right on it. Tom Lee's still bullish for the next 2 months. It's hard to be bullish in this environment. I do understand, and I want you to know that. I'm not sitting here to preach and say everything's rosy and great. You know, it's very hard, and I do understand your situation. I understand my situation. And I want you to know that I do understand it's a very tough time, like we have expected. And we've literally, you know, as a group and as a world of people who are invested in Bitcoin or invested in strategy, like we've earned this. And so it's time for people who've held the faith, who've stayed strong. It's time for them to get rewarded, is my belief. And I do think that we have a time frame coming in the future here where this could happen, and it could happen some in November and December. And it could definitely extend into 2026. And we have to look at the flip side that if it doesn't, I'm showing these videos because holding an asset like strategy long-term is not a bad thing based on the video that I saw you. You know, I'm holding Bitcoin long-term. I've been holding Bitcoin since 2018. Robert Kiyosaki says this too. I'm giving you another leader to just reinstill the longer-term approach to this. If we don't get the blow off top, if we don't get the bull run, these are just principles that one can look at to have hope in the future. Again, I'm still optimistic. We can have a higher upside to Bitcoin and strategy. Okay. So Robert Kiyosaki says, why losers lose. I was showing a friend my Coinbase app explaining that a few years ago it was pathetic. Today, my app showed my friend I have millions in Bitcoin and I think Bitcoin will double in price this year, possibly a high $200,000. Now that is extraordinarily bullish. She's still putting that on October 29th. I don't personally hold that belief that we're going to hit $200,000 this year, but this is just Robert Kiyosaki saying it. Okay. Short-term picture is choppy. Volumes are lower. Liquidity is thinner. Futures funding rates have cooled since early October, but fundamentals, they still look like we have strong fundamentals in Bitcoin. Obviously, over the long term, we have MSTR. That has extraordinarily strong fundamentals as a company. Like, it doesn't get much stronger than that, man. So maybe there's a consolidation before the climb here. Some people are predicting 150,000, 200,000 if we have an explosive run. And we'll find out, you know, if that's going to happen in the future. So we saw Strategy, $74 billion in their treasury right now. And here's just a few more things from Strategy because you watched the video and I talked about these different products, Strike, Stripe, Stride, and Stretch. If you look at them, the breakdown is this: Strike, 8% dividend, Stripe, 10% cash dividend, Stride, 10% dividend, and Stretch, variable monthly dividend yielding about 9.5%. That's why they compare Stretch more to like a money market fund with a variable monthly dividend here, okay? So these are the different products. If you want to know more about it, my book's down below. It goes in depth into these products, goes in depth into strategy, BMNR, Ethereum, Bitcoin. Go get it. It's free. It was a joy writing it. I got to do all kinds of research writing my book. It was a lot of fun. I really did heavy research into how the Fed works. If you ever really wanted to know how the Fed works, most people don't understand. If you ask 99% of the population how the Fed works, most people have no idea how the Fed works. It breaks it all down in my book, and I'll give you a little blurb on this in just a second. So here we go. Saylor with an epic closer. Adam Livingston posted this. He was actually on the Zoom. He says, Saylor says, I want MSTR to stand for monster. We want to create the digital credit instruments that are 2 to 4x better than everything in the $300 trillion market, and we want to eat the world. So they're going after the bond market. They're going after the money market, okay? They're going after these marketplaces. So there's a new phase. The battle begins. Michael Saylor warns that by the time banks endorse Bitcoin, it will be $10 million per coin, calling today's price a 99% discount. So that's what he says, you know, and I do believe him because at some point in the future, we will have a Bitcoin that's $1 million. That's not a 99% discount right now, but we will have $1 million Bitcoin in the future. And I do believe that Bitcoin will get over $10 million in the future. If you look at the S&P going at 15% a year, it's already up at 18% a year. To think that Bitcoin won't do 25% a year, I think it's just going to do on average 25% a year or more. So, and of course, up until this time, it's done way more than that on average. All right. So Michael Saylor explains how strategy Stretch offers up 10% tax-free dividends. It's not tax-free, it's tax-deferred, which is a big difference. Okay. It's not tax-free. Great. So, and the other thing with deferred, it sounds great, but you're deferring the tax. So it's just a delay. It's not like eventually you will pay a compound tax on that. So important thing that, compound, Einstein said that compound interest was one of the wonders of the world, right? But he didn't say that about compound tax. One of my mentors early on, when I worked in financial services at 21 or 22, we studied a model that was all about the velocity of money. And I learned at 22 how banks moved money. I learned all about inflation. I learned all about the different drawers of money. It was a system that had to do with personal financial engineering. And he said that, Einstein said that compound interest was one of the wonders of the world, but he didn't say compound tax. And that's the thing that you really got to watch out for is the tax. Because at some point you do pay that tax. It just compounds in the vehicle. And then the 401ks is a whole nother thing where you're not getting a tax deduction. It's a tax delay. So it's coined as a tax deduction, but you pay that back later. So it's a tax delay. So all these little terms of how things are marketed, you have to look at the actual long-term effect of it, of what it's really doing, which is why I believe. I remember when I was at that conference in 2000, in their early 2000s, there was a guy there who wrote the book called The 401k Hoax. So I already knew at 22 that the 401ks were the biggest hoax. And because they're just a bad deal. No offense if you have one, but it's not a good deal. And so many of these different instruments were created in the world so that the banks, the financial institutions, that they can hold your money. And you ever wonder why they say you have a 10% penalty before you take it out? If you take it out before 59.5, why do you think they have that penalty? So they can use your money. And there's a whole way that they move it. And I break it down in my book, Money Game. You can snag it down below. And I talk all about the 401k and how it actually works and what the institutions actually do with your money. They pool your money together and then they make money off of your money. And that would be a cool thing if like they were making, let's say, then this is hypothetical. Let's say they're making 100%. Like, that's cool. Go make 100% with my money. But like, why do I get a measly 10 to 12% of my 401k plan? And I can't touch my money over that time frame, but you can. And the way that it works is it is a symptom of a problem in the larger economy. And if you really want to break it down of how the Fed works and how the Treasury works and how before money goes into the Treasury, before the Fed turns on the money printer, I should say, who's actually making the loans in most cases to the Treasury, because there's different ways that they get loans, but they call them Treasury bonds, but let's call it what it is. It's a loan. The government's like, yo, I need a loan. And so what happens is instead of going to the Fed to get the loan, they go to the banks. And so the banks will give them the loan. And these are private banks, by the way. So the banks will give the Treasury the loan, and then the banks will hold that loan for a while because it's like, hey, yo, dad, I need some money. I'm out of money. Loan me money. So the banks make the loan. The Treasury is paying interest on the loan to the banks, private banks. The Fed doesn't want the banks holding on to that money for very long. So they swoop in months later and they go, hey, banks, we don't want you to hold that money for too long. We'll buy the loans off of you. The banks get the spread on the money. The Fed then holds the loan, and then the Treasury is in debt to the Fed. And so it's this whole loop that takes place that you'd be like, why not just like, why does it have to go where the banks are going to loan the money to the Treasury, and then the Fed is going to buy the loan from the banks, and then the Treasury is going to be in debt to the Fed? Why don't they just print the money and give it to the government? And so you watch this whole loop that takes place, and that's how it was set up. It was put into place, and it's law, and I'm not going to argue with the fact that it's law, and they're not breaking any laws doing it. But the way that it works in a loop is just so interesting, I'll just call it, because if the American public just saw that how this works, people would be like, wow, that's how it really works? That's crazy. And then eventually, how do you think the loan gets paid back? Right? So eventually you have the Treasury that has to pay the loan back. because they're now in debt to the Fed. And so your tax dollars come in. And when your tax dollars come in, some of your tax dollars are used then to pay off the loan. And guess what? Your tax dollars come in, they go back to the Fed, and when the money printer gets hit again, that money goes out to the banks. The banks then loan it back to you, and essentially you could say that the banks are reloaning you your tax dollars that you just paid. And instead of the 1% or the small percentile that they're getting a deal up at the upper levels on the loans, it comes all the way down to you and me at the bottom of the pyramid getting 7, 8, 10%, 20%, 30% loans on credit cards, because where are the credit cards coming from? Banks, financial institutions. And it's a loop. Your tax dollars are getting recycled. Pretty interesting, isn't it? Okay. That is the concept of how it works. If you want the whole breakdown of it, go do the research on it, check it out, right? But I'm giving you the hypothetical concept of how it works and breaking it down in simple terms. So this is the economy that we live in. And so the more that people know about it, again, I'm not here to speak negatively about the Fed. The Fed certainly does its job in the economy. It does what it was hired to do. It's the system that was put in place. It was the system that was voted on. It's the system that was agreed upon. It's the system that we've been on since 1913. And it's time for a new system. That's the bottom line. And that's what the blockchain is to me, a new system for the world to help people have an opportunity to go free. And that's what strategy represents, to help people really be able to retire. Okay, really be able to retire, because you get somebody who gets to retirement, and 21 years old, I was running these models. I worked for a large financial services company. I was a top producer. I was the number 5 partner out of 500 partners in the entire company. I saw how this worked at a large level. And the models we were showing in my early 20s were like, you get to retirement, you have $2 million, right? You can't spend all of your principal. So you're pulling 5% off $2 million. That's $100,000 a year. After taxes, you're taking home $70,000. Right? So those types of models were run to go, yeah, like you're going to take 5% off a year. And that's what you're going to live off of. And because if you tried to take 8 or 10% off a year, and here's the problem with it, which is why products like Stretch are so interesting. And listen, I don't get anything for talking about these products. I just admire what's happening here. I have no affiliation with strategy on this. And so when you look at these products and you go, the current scene is if somebody wants to take 10% off their money, like they got $2 million retirement, let's just use a round number, $1 million. If they want to take 10% off their money at retirement, and they're like, I'm going to keep my money in the stock market, and they're like, I want to take 10% of my money, and I need $100,000 a year to live on. $1 million, 10%, $100,000. After taxes, still only $70,000. But they're like, I want to take 10%. But the problem is if they have $1 million in equities, and then the year they decide they want to retire and their equity portfolio goes down 20%, now all of a sudden their $1 million becomes $800,000, and they're trying to pull 10% off $800,000, and now they're living on $80,000 instead of $100,000. It doesn't work because of the risk of being in the market at retirement. So these vehicles that Saylor's putting in the marketplace to go, he's basically, like, from my viewpoint, replacing the stock market returns, not the stock market, but the stock market returns. Because go on the street and ask somebody, hey, what'd you do in your portfolio this year? Most of them are going to tell you, I did 10% or I did 12%. If they invested in the S&P 500, they would have done better. But they get in all these funds inside their 401k plans. They got management fees. They close their eyes. They pick these funds. I was sitting with somebody the other day. I'm like, dude, like, you're so young. How are you only getting 7%? This is insane, right? So that's a young person who has a high risk profile. So many people don't even know what they're earning in their 401k. Plus, you have the fund management fees. 401k plans have facilitator fees. And so they're earning less than 10% if you have fund fees too. So even when somebody gets to retirement, like, it's hypothetically, these products that Saylor has can replace the stock market for people in retirement, because you don't really necessarily want to take that risk for somebody who's older to be in the stock market where their portfolio could drop. So what do? Instead of just doing stocks, they do stocks with an average, like a portion of bonds in it. And then the bonds lower their rates of return from like a 10% to way lower. And they can't live off 8% or 7% withdrawals in a year. They can't live off that. So now you come in with something like Stretch, that like you don't have to worry about the ups and downs if you believe that Bitcoin is a pristine asset, if you believe that strategy is going to be here into the future, if you believe the company who owns the most amount of Bitcoin on the face of the planet is going to be around, then you put your money in Stretch. Not financial advice. This is what I would do if I was much older. I'd put my money in Stretch and I'd be like, yo, I'll take the 10% a year, and if I don't need my money right now, let it grow at 10%. So that's the comparable magnitude of the new system versus the old system. And when you have something like Bitcoin, which is the whole moral of the story, that literally backs up strategy's entire strategy of issuing these preferred stocks in the marketplace that can give retirees income, when you actually have this type of collateral, Bitcoin, you have a solid asset that's based on scarcity and being finite versus the dollar. And the reason you get all these shitty rates of return is because all these institutions are over leveraged. Not all. I don't like to use the statement all. They're over leveraged. And they're using a dollar that is printed more and more every year. That's going to crap. And we will stay strong in the dollar because the U.S. will maintain its trade relationships. And the dollar's been strong for a long period of time. But that doesn't change the fact that it's getting debased. Okay, so comparatively to other currencies, the dollar will be strong and the dollar will be the leader. And the fact that the dollar is backing the stablecoin market right now, where every stablecoin is backed by a dollar. But if you listen to Anthony Pompliano's video the other day, he talks about one day people will just say the dollar, the stable coins, the digital dollars won't be called digital dollars. They'll just be called the dollar, because the entire of Wall Street will move on to the blockchain and you'll just have a dollar on a better technology, not a broken financial system. Okay, so that's the gist of what's going on. And that's what I'm a part of. You're a part of. You have the know-how of this. Like one of the most brilliant companies on planet Earth is Strategy. One of the most brilliant minds on planet Earth is Michael Saylor. Most brilliant. He is doing something for the future, for people. He's helping people. Now, we don't say that when we wake up and our stock drops 10%. We're like, this ain't helping us. But I'm instilling this into the future. Again, I am not sugarcoating the fact that the stock is down. And I completely understand if your portfolio is down and you bought in Strategy when it was higher and it went down. I understand that reality completely. What I'm just trying to paint is not sugarcoat the current reality, just to look at the future of the facts of the company that I'm invested in. Strategy is going to do incredible good for the planet. Incredible good because of the products they're issuing and the number of families that could retire and will be able to retire or have a better life because of these financial instruments, not the common shares like we own that are super volatile. You're not going to get your 80-year-old, father into this. Although I have a client who just signed up with us today for our trading course. He's 82 years old. He's invested in Strategy. He watches the show. So you talk about admiration for people like that. I have total admiration for somebody like that who's actually has a bigger future and wants to know about these things. My stepfather, who's 81 years old, is in Bitcoin. Now, we got him in Bitcoin at $15,000, so he's doing pretty well. But he holds Bitcoin. And the other day he came to us and he's like, I think I'm going to sell it to go on that next vacation that we want to go to. My brother and I are like, all right, not financial advice, but if we were in your position, sell your dirty fiat, not your Bitcoin. Okay, so he's holding on to his Bitcoin. Okay, so this is the new world. I wanted to show you that video. If you missed this and you just came to the show, go back to the 40-minute mark or whatever. Go watch the video from Michael Saylor. He talks about the Q3 earnings. He talks about what Strategy is doing, and I break it down and it explains to you again how powerful this company is. Man, it will be the one of the giants of companies of the world. And you have, I one day I hope to meet Michael Saylor because he is a fearless leader. I have not met him. I can't vouch for everything that he does, but based on how he talks and the actions he's taken, he is an ethical leader. And I believe he has the best interest of his customers in mind. Otherwise, he would be taking $2 billion, $3 billion tomorrow from anybody who wants to give it to him because they want to give it to him, but he's not taking the fast, quick money. He's building Strategy in the right way. So hats off to you, Michael Saylor, okay? I hope you all have a great rest of the day. If you want to go get my book, Money Game, you can subscribe to the channel, like it, of course. But if you want my Money Game book, it's down below. You just go grab it. It's free. Also, we send out a video of my trading strategy. One of the reasons I can be more optimistic when the market's down is because I trade and I pick up shares almost every day. Sometimes I lose, but 15 out of 16 weeks trading BMNR, I've been profitable. So I'm 90-something%. And the losses feel like a punch in the face when you get them. So sometimes when you have 10 wins and then you have one loss, it's like, oh my God. But at the end of the day, it's great to be in this community of people who are in Bitcoin. It's great to be in a new financial world that is evolving. It's here, but it's not here for the rest of the population yet. And it's great to be ahead of the curve. So hats off to you for being a leader in that. It's more of us educating people, not telling them to invest, but educating them on what the new financial world is, because it's here and people need to know about it. And it's a disservice for them not to know about it, because we want people to be okay. We want their families to be okay. And certainly the idea of selling the middle class, everything's going to be okay, get 12% in the stock market, buy the house of your dreams, drive the nice car, go get the middle class job. The middle class is a trap. And the way out is what we're talking about on this channel, and what many great people on YouTube are talking about, who talk about Bitcoin and talk about Ethereum and talk about the future financial world. So kudos to you. Hats off. Keep the faith. It's been a rough time, but keep the faith and do what's best for you. Make your own decisions. See you soon. Stay well.